Welcome, fellow traders, to today's webinar about short-term scalping strategies in FX for those of you who want to start trying out how scalping works and if it is the right trading style for you. So we'll be discussing a couple of tips and tricks, a couple of points that you definitely need to keep in mind when it comes to scalping, and then obviously later on you can make a decision whether scalping really is for you or you would better try to trade a longer term. Okay. So while we have a couple of last people connecting to this webinar, let me just quickly go through the disclaimer, so bear with me for a moment. Contents of this material are provided by third party, not hard Forex, and are for informational purposes only and do not constitute investment advice. Hot Forex and Blue Sky Forex assume no responsibility for any potential errors, inaccuracies, or omissions in this material. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of purchase or sale of any financial instrument. Any views or opinions presented within this material are solely those of the author and do not necessarily represent those of Hot Forex unless otherwise specifically stated. Currency trading may not be suitable for all investors as it carries a high degree of risk to your capital. Trading such products is risky and you may lose all of your investment. Past performance is not indicative of future results. Poor fill rates, expiry times, market volatility, and platform errors could result in losing trades. Before deciding to invest in currencies, you should carefully consider your investment objectives, level of experience, and risk appetite. You should be aware of all the risks associated with foreign exchange and currency trading and seek advice from an independent financial advisor if necessary. So with this out of the way, let's just quickly take a look at our agenda today. I will first quickly introduce myself. We'll then take a look at two market types that you will come across during your daily trading activities, and we'll see where scalping works best. Then we will go through 4 steps that you do need to consider and keep in mind when you are scalping and how to scalp effectively. And of course, last but not least, we have the currency trading dangers, and especially when it comes to scalping. So important things for you to keep in mind. And of course, at the very end, you can ask questions. So please write them down during the webinar. Ask away at the end. I'll do my very best to answer them. Okay. So I am one of the senior traders here in Blue Sky Forex. We are an education, research, and trading group. We teach various strategies, and we do provide 24-hour trade support and analysis just to help the FX traders to trade safer and make better trading decisions. Blue Sky Forex is presenting this webinar on behalf of Hot Forex in order to educate you and help you become highly profitable currency traders. So let's take I'll take a look at 2 market types that you will come across. First of all, it is price action, aka trending market. Okay, this definitely tends to be more powerful. These significant moves that are defined by significant trends, they do need to be fueled by news that matter. Okay, so significant news that carry weight, these will drive the price in a certain direction for an extended amount of time, which we retail traders can successfully benefit from if we have the knowledge how to do that. Okay. I will show you how a trending market looks like as well in a moment. And then we have mean reversion market, which is more common. It is easier to identify than a trending market, and it can be profitable. Depends on how you utilize it. Okay. Scalping itself, it can be used on both market types successfully, although it is a bit better or easier to carry out during a trending market, and I will show you why. Okay. Ultimately, it actually still just boils down to your own emotion control, and how you want to manage your trades, and how keen are you on initiating multiple trades during a single trading session, and if you want to initiate more trades rather than less trades. Okay, and if you want to get fast in, fast out, or you want to prefer these longer duration trades. Okay, so you will first of all need to identify what market type you're trading in, and of course make your trading decisions adequately based on that. So at the very left side here, between those two black lines, you have a ranging market where the price is bouncing between the nearest support and the nearest resistance level. Okay, so these black lines represent the nearest support and resistance level at this point. Essentially, these support and resistance level, they will contain the price, that will prevent the price from going out of this range certain amount of time until it breaks out. So let's pretend there was some significant macroeconomic news hitting the market and the price broke out from the range and started trending. Okay, so you all know that the price never moves in a straight or a linear line. It moves so in waves, and knowing the Elliott wave theory here would be beneficial, although not completely required in order to trade successfully. Okay, Elliott wave theory will be useful in your daily trading activities, so if you do have the time, it's really worth looking into. So the market, when it is trending, it moves in impulse and corrective waves. The impulse waves are the price movements that move in the direction of the trend, and the corrective waves are the price corrections, aka the moves against the trend where the price is correcting the previous larger move. Okay, so the price moves in waves, and at the very end of the trend, the price, you will see it petering out. You'll see some exhaustion setting in, some indecision. You have a few dojis here. You have engulfing candles, and the price consolidates and starts ranging again. Okay, so now you see again the price is ranging and bouncing between the nearest support resistance level until it breaks out again and starts trending, etc. So it goes on like that. Okay. Now, the very easiest approach you can take when you are dealing with a ranging market is just going long when the price hits the nearest support level, and going short, aka trending down, when the price hits the nearest resistance level. So it's a very, very simple approach, although I just want to stress the fact here that this kind of very simplistic approach, it might work some few times, but longer term it will not actually work. It's exactly the same if you simply used relative strength index, the RSI, and traded long when the RSI was at 30 or lower, and then going short when the RSI was showing you a 70 or higher, right? It might work a few times, but at longer term, it will not work out for you. You definitely need to very deeply analyze the market if you want to use this simplistic approach. Just consider where the price is coming from, if there are any news hitting the market soon or have hit the market just recently, how strong these support and resistance levels are that are containing the price, etc. Okay. Now, in a trending market, a very simplistic approach to use to scalp this would be to wait until the corrective wave finishes and another impulse wave starts. Okay. So first you have the first impulse wave, then you have the price, correcting itself. It's coming down a bit. Usually the corrective waves, not usually, but often, are to around 50 or 60, 65% mark. Okay, 50, 60% retracement, and then you will have another impulse wave starting. So as soon as you see the impulse wave the corrective wave and the price reaching around the 50-60% retracement, start looking for exhaustion setting in. Okay, if you see some indication of the price reversing again at this point, then you should look for trade entries. All right, and then just simply trade along with the next impulse wave. Very, very simplistic and straightforward approach. It works better than simply going long at the support and going short at the resistance, right? Now about the take profit and stop loss levels, if you considering and keeping in mind that we are talking about scalping here, okay, then your stop loss would be at the point of the breakout from the range, maybe a bit lower below that point, because the support resistance levels, they quite rarely bounce the price exactly when the price reaches that level. Usually they pierce it a bit, like you see here and here. The price goes a bit lower than the support level and goes a bit higher than the resistance level. So setting your stop loss, just on this example, setting your stop loss just below this newly created support level would be sensical. Okay. Now about the take profit, you would always need to keep a positive risk-reward ratio, which means risk-reward ratio of 1-to-1 is an adequate ratio to start off with. That means that your take profit level is exactly the same distance from your entry as your stop loss. Okay, so let's say that you entered your trade here and just below the breakout point you have the stop loss, which is, let's say, 30 pips away. That means your take profit will also be 30 pips away in the other direction. Okay, that is the first take profit stop loss combination you can use. The other one is you can set your take profit at the very peak of the previous impulse wave. Okay, so as the price reaches the same level as the previous reversal, here you can take your profit. And based on your risk-reward ratio, you can set your stop loss here. Okay, now ultimately it would be a lot better if you increase your risk-reward ratio even towards the positive side again and set it to around 1-to-2, which means your take profit is 2 times the distance of your stop loss. Okay, so putting it really bluntly, you will expect to win 2 times as much as you risk to lose. Okay, so you risk to lose, let's say 30 pips, but you expect to win 60 pips. Make sense? Really easy, really straightforward. If you go on and if you become more profitable and more experienced, then having even a better risk-reward ratio is always beneficial, like 1-to-3, 1-to-4. But I wouldn't really go too far, because otherwise you will create a situation where you are unable to for your trades to hit the take profit, because it is too far away compared to your stop loss. Okay, so if your stop loss is only 20 pips away from your entry price and your take profit is 150 pips away, then first of all your trades would last forever before they potentially hit your take profit. And usually within that time frame, the price already reverses and hits your stop loss instead. Okay, so keep that in mind. Don't overdo the risk-reward ratio. Really important here. All right. Now, considering the ranging market again, as mentioned on the slide as well, when the market is ranging, price is bouncing between the nearest support and resistance levels. And then these support resistance levels you can often find on any market news related websites. They have these daily support resistance levels marked down somewhere, and it's really just easy to consider those levels and trade by them. Okay, So the next thing you have to keep in mind, and it's a lot more important than the very first point. You have to, as you are aiming for these low pip gains, and you are aiming for a very high frequency, a very high amount of trades during your trading session, the first thing is spread. Okay, the spread is the amount between the current price, between buying and selling a currency from your perspective. Okay, essentially it's the difference between the bid and ask. All right, so whenever you make a trade, you are already, at that very moment, you have already lost a little bit, the amount of the spread. Okay, that goes for the broker. Now, as you are initiating a lot of trades, if you're scalping, doing a trading session, then you have to keep the spread in mind, because longer term, the more trades you initiate, the more money he will pay for the spread, essentially, just putting it really, really simply. Okay. Now the spread, the amount of spread that is applied for a currency pair, that does depend on the broker's competitive pricing, and of course the underlying assets liquidity, volatility dynamics of that certain currency pair. Okay. If you are scalping, it's highly recommended to scalp the major currency pairs, because they do have lower spreads than exotic and cross pairs. So definitely keep that in mind. One of the lowest spread pairs you have is Euro USD, two of the most traded currencies in the world. So indeed, trade the majors, okay, just to get the lower spread possible. Another thing is liquidity. Highly liquid currencies, like the majors, they do tend to obey the laws of ranging and the trending market better than the low liquidity pairs. Okay, on the low liquidity pairs, there can be extreme moves happening, extreme spikes occasionally, because the volumes vary greatly of those traded currency pairs. Okay, so go for the high liquid pairs, the pairs that are traded the most. They are most stable. Okay, so in this case, any smaller spike, if you are trading an exotic pair and you are scalping and your stop loss is only like 20 pips away from your entry price, any smaller spike setting into the exotic pair will simply make your trade hit the stop loss before it actually would have ended up being really profitable. Okay, so low liquid currency pairs, they do have the spikes that really can damage your overall profitability. Okay, I have information that somebody is not really seeing the screen. Let me just pause it and share again. Usually this fixes the viewability. Okay, I hope you see the screen now. Anyways, let's continue. A couple of more topics to discuss. Okay, the third point that you need to consider when you're scalping, you need to calibrate your charts accordingly. Okay. All right, so what is most important is that you do need to have multiple different time frames available. When you are trading with a big Forex broker like Hot Forex, you will most likely be using the MetaTrader 4 platform, which does have all the necessary chart time frames available, ranging from 1 minute up till monthly charts. So what you will need to have access to is definitely a 15-minute chart, depending on preference, a 30-minute chart perhaps, and of course a 1 hour and a 4 hour chart. Okay, as you are scalping and you are aiming for these low pip gains, then a 4 hour chart is something you will rarely use. However, I use it very often. Of course, depending on the market conditions, but I use 4 hour charts quite often to get a larger picture, a broader picture of the market condition and what the market is doing on a larger scale. Okay, I do prefer 1 hour charts. These are my favorite, but when engaging in scalping, then it's completely fine to use 15-minute charts over 1 hour charts. Okay, and you're aiming for around maximum 5 trades. Maybe some of you want to initiate 10 trades per day, which is also fine, but don't go really over the board. Initiating anything over 10 trades per day is already a bit overkill. So try to keep it around 5, 6, or 7. That's completely fine. This will allow you to also focus on not simply eyeballing your active trades, but to actually engage with analyzing the price charts properly and making your trading decisions adequately as well. Okay, you need to give yourself enough time to dive into the charts and understanding what's actually going on the market. Okay, in this, if you dedicate sufficient amount of time to analyzing the charts, there's a higher probability that you will be able to determine whether the market conditions are really suitable for your scalping strategy or not. Then you can successfully understand whether you should be trading at that moment or should be actually stepping away from your trading portal and taking a break, or just return later on when everything has settled in, or simply return in your next scheduled trading session is beginning, aka the next day. Okay, so definitely keep it to 15-minute 1 hour charts. Zoom out to 4 hour charts if you want a larger picture of the market, and try to refrain from using only 4 hour daily or 12-hour charts to make your trading decisions when you're scalping. This does not really make sense, right? If you use 5-minute chart, sorry for interruption. Victor, this webinar has slides and this is with video as well. I have no other people reporting any issues, so it must be on your side. Anyways, where were we? Okay, now the second thing is positioning the trade and going and zooming into a lower time frame charts like 1 minute, 5-minute charts. Now, using 1 minute charts, I never actually do that myself. It contains too much noise for me to adequately make my trading decisions upon, even to pinpoint the entry. Okay, 1 minute charts is too little. I go down maximum to 5-minute charts just to pinpoint my entry. And you can go ahead and use, in example, moving averages, moving average crossovers, and of course, implement support and resistance level knowledge into making your final trading decision. Okay, in terms of using moving average crossovers, obviously you need to have one slow moving average. A very popular slow moving average period is 200, and then a faster moving average is like 50 period ones. And these crossovers between those two period moving average can result in good entry spots. If you are trading on a trending market, an example, after a corrective wave, you wait until the price moves, or when the quicker moving average moves back across the slower moving average, and that would be your point of entry, an example, just to trade with the next impulse wave. Okay, like I showed you before. So using moving average crossovers is a good point. And just keep in mind the resistance and support levels, because it doesn't really make sense to go long if the price is reaching a relatively strong resistance level. And it doesn't really make sense to go short if the price is reaching the nearest or very relatively strong support level. Okay. So definitely something to keep in mind. Incorporate moving averages and support resistance levels. Now the fourth point is, as mentioned before, use the crossovers for moving averages. You can also use crossovers of certain other indicators. Some use crossovers of the relative strength index. They set a line in the middle, which is the level of 50, and a trade along with the trend when the RSI comes back from one side and crosses over the level of 50. Okay, so crossovers doesn't only mean the moving average crossovers, but these crossovers can also be incorporated into other indicators like the RSI. Okay, but yeah, the most popular is the moving average ones. Then we have the overbought, oversold, and oscillator indicators. We're talking about, again, the RSI, which is a overbought, oversold indicator. Another one is stochastics, which you can use. A good way also to use this one is that it has also two lines, and you can visualize the crossovers inside the stochastic indicator as well. Sorry. And then we have other oscillator indicators that can be used in conjunction with trading or scalping in a trending market and in the ranging market as well. It's really easy to use stochastics or an RSI during a ranging market if the price is at the very top of the range and you see the overbought, oversold indicators showing the price being overbought, then you can easily go short, and vice versa. Okay. And the third indicator you have is the Bollinger Bands. Bollinger Bands is, in fact, our favorite technical indicators of all time. A lot of our personal and company strategies rely on the Bollinger Bands. Okay, so there are different Bollinger Band formations that you can visually catch on every day on the charts. There are patterns that you can follow, and these patterns provide you with good trading opportunities, no matter whether you're scalping or day trading or position trading. Okay, Bollinger Bands are always, to our mind, the best technical indicator that you can use. Okay. We do have another webinar where we do show a few of these strategies that we use on a daily basis, and of course a few formations of the Bollinger Bands that you can incorporate to your trading activities as well. Okay, so using technical indicators, definitely useful when you are scalping. Now about risk reward, as I mentioned before, using a risk reward ratio It's actually a bit upside down on this slide. I do apologize for that. We're talking about risk-reward ratio, then it should be 1 to 2. We're talking about reward-risk ratio, it's 2 to 1, okay? So just making that statement so it wouldn't really be confusing. People say reward-risk ratio or risk-reward ratio in either way, so the principle still remains the same, okay? So keep the risk-reward ratio to 1 to 1 at first. That means your take profit and stop loss levels are exactly the same distance from your entry. Increasing the risk-reward ratio later on is definitely beneficial, as you will allow yourself to win more while risking less, okay? And when you are scalping, obviously you're aiming for these small and quick pip gains versus longer trades. And your stop loss can range anywhere from maybe 10, 15 pips up to 50 pips. And of course, your take profit, you can calculate this based on your risk-reward ratio as well. Okay. Now, definitely do not wager more than 1% of your total account equity on any single trade position. You don't want to risk too much. You don't want to blow any of your accounts. Although there's nothing really bad about emptying 1 or 2 accounts. I can talk about that a bit later. So if in a single trading session you lose more than 5% of your total account equity, then it's best if you simply stop trading and walk away just to fight another day. Okay, so it is extremely important to set trading rules, and you need to follow them extremely precisely and without making any exceptions. Okay, you have heard the expression that rules are meant to be broken, but it's not the case when it comes to trading. Okay, when you are trading and you set rules to yourself, it's really important to stick to them. Okay, you have to be strict. And set your daily goals. Okay, before starting to trade, just analyze how you have been doing for the past week, an example. If you are in a bit of profit, then you can adjust your daily trading targets accordingly. And let's say you aim to win in a single trading session 100 pips of profit, which is completely reasonable. And you, in worst case scenario, accept a loss of 50 pips. Okay, so 150 pips profit and 50 pips of loss. So that means that your risk-reward ratio is 1 to 3. Okay, this is a positive ratio. This is a relatively standard or average way to approach or set targets to your trading session. Whenever you reach either of those targets, simply stop and walk away. Okay, because if you are near that 150 pips, you see that fine, I'm going to reach that goal. There's a lot of different chemical reactions that are happening in your brain. These chemical reactions, they flood your brain with different hormones and chemicals, and these make you feel invincible. These make you want to earn even more. Okay, you want to win more. And you can start over trading, and eventually you are full of euphoria, and you actually stop analyzing the markets enough and start making silly mistakes. Okay, and this can lead to actually either completely wasting the profits that you have earned that day, or even you can go into the negative side and lose some money. All right, so, and on the other hand, if you are hitting your stop loss, then at the same time your brain is flooded with different chemicals, reactions are happening there, and then happens what we call, or what professors call, an amygdala hijack. Okay, so your basic instincts take over. You want to survive, you actually get angry, and you want to earn back the lost money. And then you also start making silly mistakes and can even cause a bigger damage to your account. Okay, so on both sides, it's really important to have discipline, and it's important to being able to stick to those targets that you have set for yourself and not break those. Okay, it all comes down to emotion control and how you set your rules. Okay, and it's extremely important to stick to those. Please keep that in mind. Most of the traders, they let themselves be carried away, and eventually they empty their account. They complain that the market is so difficult, the trading is not really for them, and they never return. And this is their opinion of trading, that the whole thing is a scam because they have lost money. Okay, if you want to be among the 5% of retail traders who actually make money on the longer term, then it is really important to stick to your rules, and you need to be able to set adequate rules as well. Okay, don't set unrealistic targets for your monthly trading or for your single trading session. Okay, it will come in time. You will determine the best targets for yourself that you can actually reach. So yeah, just practice around and see how it goes. Now, about adding position when in loss, this is called martingale, and it's extremely risky. You can easily empty your account, and if you haven't heard of it before, it's essentially doubling up your position on the same asset and the same direction. Okay, we do have an alternative to it, and this is called a dollar cost averaging. It is gently building up your position that you would have originally invested on a single trade, but you're, instead of initiating a single trade, you're initiating multiple consecutive trades, but each with a lower lot size, and all of these multiple trades total lot size equals what you would have traded in the first place by standard. Okay, what I mean by this is, if your standard lot size that you usually trade is 1 lot size, then instead of initiating one trade, you initiate 3 trades consecutively if the price is moving against you. And each and every trade is, in example, with a lot size of 0.3, then 0.3, and the third trade would be with 0.4. And the third trade would have the best price possible. I'm sorry, not best price possible, but the best price out of those 3 trades. Okay, so you are averaging your entry price essentially. Okay, and this works well if your trade accuracy is not really high. If your trade accuracy is anywhere lower than 55%, for example, then this dollar cost averaging can really increase your earned profits longer term. However, if your trade accuracy by initiating only one single trade each and every time, if it is really high, around 60% or even more, then this dollar cost averaging can actually erode your profits longer term. So first of all, analyze your trade accuracy and then decide whether you want to implement this dollar cost averaging approach or not. Okay. So a few dangers when it comes to scalping. First and foremost, and this applies to not only scalping, but for any trading style you practice, do not trust bots. Most of them are designed to generate losses on your trading account. So you have to be extremely careful. If you want to try out a trading bot or an expert advisor on MetaTrader 4, then please do so with a demo account at first. If on a demo account, it was able to earn you consistent profits over an extensive amount of time, like 5, 6, 7 months, then go ahead and set it up on a live account. But again, please be really careful and set a really low lot size for these trades. Okay. The best thing you can still do is just trade yourself, because you are the best expert advisor, so to say, right? Another thing when you're scalping, try to stay out when you have medium or high impact news upcoming. When you are deciding to jump into a scalp trade and there is a news upcoming, let's say you have entered the trade and you didn't check if there was news, and news hits the market, and really heavy volatility sets in. Okay, so the bulls and bears are fighting over the asset, who wins. At that very time, you see extreme high volatility, you see heavy spikes in both directions, and especially with scalping, as your stop loss and take profit, they are relatively small, then it's really easy to hit your stop loss. On the other hand, it's relatively easy to hit your take profit as well, but in this case, if you look at it like that, you are ultimately gambling, right? You're just hoping to see which target is hit first. Nothing more to it. Okay, so try to stay out from news. Again, want to mention spreads, as it's a high trade volume, low pip margin trading style. Then spreads can really hurt your total gains longer term. So try to stick to trading majors only. Those have the lowest spreads available. Okay. So last thing is indeed technicals, and of course the fundamental conditions of the market. A really spooky market, so to say, undecisive price movements can cause ranging markets that can really easily turn against you and can really easily trigger your stop losses. So while scalping, to my mind, is a very technical trading style, because most likely you will end up using a lot of technical indicators that will help you with your trade entries and show a relatively good picture of the technical market conditions shorter term. Then of course, relying only on the technical indicators is not really wise either. You still have to understand the broader picture, what is going on the market and fundamentally. Okay, so keep that in mind. So that is it. Few ideas, few things to keep in mind when you want to try out scalping and see if it actually works out for you. The key takeaway here is that scalping is a high frequency trading style with low pip gain margins. So definitely try to stay out from news when you have extreme volatility on the market. Then perhaps best to wait a bit when it calms down a bit. Okay. So go ahead, write in the questions section if you have any questions. I'll do my best to answer them. And if some question remains unanswered, then please don't hesitate to send an email to webinars@hotforex.com, and they will do their best to answer as well. Hi, Ivan. Today's webinar is more of a theoretical webinar. We're not scheduled to open up a chart and trying to find any potential scalping setups. This is just a theoretical webinar for you to take away the theoretical part to implement it to your trading practices. Ajay is asking how to identify the best ranging markets. Well, obviously, the very first visual representation of a ranging market is when the price is moving horizontally relatively, right? Now, if you can draw a static line at the peaks of the price on several occasions and at the bottoms of the price on several occasions, and then simply analyze if the price is indeed on several occasions mainly bouncing off the support and resistance level only, then you have the price significantly ranging and you're dealing with a ranging market condition. If the price is wildly jumping around and it's not really testing any specific price level consecutively, then the market is in a really indecisive mode and is yet to decide when it starts either trending or ranging. Okay. Okay, Renzo is asking, can you explain why bots are not good? Aren't they better in following rules strictly? That's a really good question. I personally, back in the days, dealt with a lot of different expert advisors, trading bots. I actually just, played around with the code, played out or developed a few of my own simplistic strategies, back tested them for tens of years. And what I have found that even if a single trading strategy or a set of conditions inside a trading bot, if they work really, really well for 1 year in example, okay, then making the conditions or just testing it further for around 5 years, an example, or even more, then for the other 4 years, it can fail miserably. Okay, and it's not easy at all to actually develop a trading bot that is successful longer term, because if you develop a trading strategy by analyzing the price movements for 1 year and setting the conditions that would really work well for that year, it doesn't necessarily mean that those same conditions would work for the next 5 years or would have worked well, 5 years prior to the data set that you used for creating the conditions, if you know what I mean. So essentially, for example, I developed the strategy that was foolproof, worked extremely well for 1 year, and then I went ahead and tested it extensively for 10 years. And for the other 7 or 6 years, it failed miserably, and it ultimately stayed in balance. So the good years, they made up for the losses of the losing years, but ultimately, it remained in balance or earned a bit of losses. So developing a trading bot is not easy, even though it manages to follow the rules strictly. Still, the conditions, they can work for 1 year, but it doesn't work for the other years. So yeah, when you find an expert advisor online and you have been provided with a track record of 1 year that, hey, watch my bot, it works really well for the past year, sure. But if you cannot really do a back test for another 2 or 3 years to see how it performed, then it's really no point to try it out, because prior to that 1 year when it was successful, it might have failed miserably. Okay, and the future market conditions will really likely change as well. I mean, market always changes because there are different traders entering the market with different psychological approaches. So that makes the market change all the time and the conditions as well. So following one simple trading strategy for 10 years, it's not going to really work out. Okay. Osarboro is asking, what is a scalping strategy that can be employed for good returns? Sure, we're not really here to discuss specific strategies that you can implement for scalping, but you will find tons of different strategies for scalping out there. Most of them rely on technical indicators, but one of the simplistic approaches that you can take that doesn't really rely on any technical indicators is scalping the start of the impulse waves, like explained here. So you have the impulse wave, you have the corrective wave, and as soon as a new impulse wave starts, you see a bit of indecision here, right? So when the new impulse wave starts, you can actually trade along with the trend and just the next impulse wave. Okay, this is just price action. Okay, so it doesn't really involve any technical indicators, although you can use trend lines to find the potential reversal points where the corrective waves might end and reverse and turn into another impulse wave. You can use trend lines for that. You can use Bollinger Bands for that. You can use moving averages for that. So yeah, this is one of the simplistic approaches you can take. The Elliott wave theory will play an important role in this trading method. So knowing that will be beneficial, although not entirely required, because the only thing you need to keep in mind is the market moves in waves, right? It never moves in a linear or straight line. So you can benefit from these corrective and impulse waves. You can even theoretically trade against the trend when the impulse wave has ended and we are dealing with the corrective waves just until the actual trend line. Okay, so that is an option. Although it is a bit more riskier to trade against the trend than it is to trade with the trend. Okay, you most likely have heard the expression that trend is your friend, which is generally true. Okay. Raihan is asking, how can I reduce my risk when scalping? It's a really good question because we always want our community to trade as safe as possible, and we also want any trader to trade as safe as possible because you know that we are retail traders, right? We are the small fish in the big sea, so we don't really want to get caught between the shark's jaws and be eaten, right? So you always have to be as safe as possible when you do engage in markets, and to be um, trading as safe as possible, you need to be mindful of the market conditions. What are the latest news that have been released? What is the fundamental condition of the market at the moment, whether it is ranging or whether it is trending? Please don't always use a positive risk reward ratio. That means that your potential wins are uh, higher than your potential losses. Just keep the risk reward ratio positive. Try to refrain from using bots. What else? Trade on major pairs with at least lowest spread possible. Then don't use high time frame charts because you don't really get a good view of what's going on the smaller time frame just to pinpoint your entries. Be mindful of the nearest support resistance levels. If there are any relatively strong support resistance levels nearby and you are actually trading towards that level, then it's best to not engage that trade specifically. Just wait, see what happens, and then continue. Okay. And of course, try to stay away from martingale. Okay, Caleb is saying, can you explain again what scalping really is? Sure. Scalping is a high frequency trading style that aims to reap uh, quick and small profits with a lot of trades during a single trading session. So essentially, quickly in, quickly out, right? So the trades are short; they don't last for a very long time, and you will exit the trade as soon as it makes sense, right? If you have your trade 20 pips in profit and you see even the slightest indecision or exhaustion setting into the price movement, you simply lock in your gains and you exit your trade. And you constantly keep on monitoring the market to find new trade opportunities, and you expect those small pip gains with low potential losses per trading opportunity, which means your take profit and stop loss levels are relatively low, just to allow you to get in and out of a single trade very quickly. So that is a scalping trading style. Okay, Mofama is asking, what happens when you open trades and not set a stop loss and the take profit? In this case, essentially, when you enter the trade, you let the trade run as long as you either uh, hit a margin call, if you're trading on margin, or if it goes in the other direction, in the profit direction, you can simply let the profits run. Okay, sometimes does happen rarely, but it does happen when the actual broker steps in and close your trade for any particular reason they want. But otherwise, your trades can last for a very long time. So it's really, that leads me to a really important point here that I didn't mention before. When you are trading, doesn't matter whether you're scalping or whether you are using any other trading style, as soon as you enter the trade or even before that, please make sure you set your take profit and stop loss levels in place, and do not meddle with them later on. Do not modify them later, and don't touch them. Okay. Even if your emotions say that, hey, I want to actually earn a bit more with that single trade, I should move that take profit a bit further, don't do that, because you can create a scenario when you just keep on doing that over and over again, and eventually the market will reverse and you have lost all your profits for that particular trade, right? So set your take profit and stop loss levels in place immediately when entering the trade, and don't touch them later on. Okay. Okay, Abanda is asking, where can we watch the video or the recording? The recording is uploaded on the Hot Forex webinars website, webinar section. So if you log into your Hot Forex account, you go to the webinar section, and under the past webinars, you will see the recordings of those webinars. There are a lot of different topics there. Okay, Corredi is asking, what is a bot? Sure, a bot, or an expert advisor, in other words, in MetaTrader 4, is a robot that is making the trading decisions in behalf of you and actually initiating the trades and exiting the trades in behalf of you as well, based on certain set rules. Okay, so ultimately, you are not trading yourself, you're letting somebody else trade in behalf of you. Okay. Now, when you let a person trade in behalf of you, that certain person needs to have a valid license to do so. Without having a license, that person is not allowed to trade in behalf of you. And if he does, he will face very severe legal consequences. Okay, so only credible investors and credible traders, accredited traders, so to say, we can trade your account in behalf of you. And that all needs to be legal. Now, bots, however, these robots, they don't require this consent, right? They don't require any legal allowance to trade in behalf of you, because you are the one requesting this action by them, right? So um, yeah, that's a bot, that's a robot, just trading in behalf of you. Really dangerous, by the way. David is asking, what about a trading stop loss? Yes, trading stop loss, it is an interesting thing. We actually have a new topic, a new webinar about the trading stop and how it can be set up with the trade. When you are scalping, however, trading stop is not really useful, because the trading stop should only be used when you are a longer term trader, when you are position trading, day trading, or aiming for these larger pip gains like 100 pips and onwards. Then a trading stop will be useful, okay? Because there is really no point to set the trading stop for 5 pips from from the current price, because the price fluctuations are way larger than 5 pips to either direction. So it's the same if you simply just go ahead and exit the trade, unless you're dealing with some extremely uh, high impact news that only moves the price in only one direction. But that's really rare to happen, right? So you're better off just skipping the trailing stop when you're scalping, because the trailing stop will become useful if you can set the distance for around 15 or 20 pips from the current price, okay? And this only will have an effect when you are position or trade trading, for example. Okay, Pekog is asking, quite an interesting question. When you have a period of losing a trade or trades, would you change your strategy or still had faith on the strategy till the market conditions changed and the strategy would become successful? The thing is that if you're trading with a certain strategy that you have developed for yourself and you are consistently earning losses, and I mean consistently by trading few months with that certain strategy and seeing your account balance decreasing uh, in a stable rate, that means that the strategy is not really suitable for your trading mentality or your trading style, so you should change something. And as I have mentioned before, that it's not really good if you change absolutely everything in a trading strategy. Just change a part in it, okay? Just change how you manage your money, or change your risk reward ratio, change your entry conditions, change something. You don't have to change everything, because a trading strategy consists of your emotion control, your money management, the technical indicators that you use. A strategy consists of what session you're trade at, and all these kind of small things put together results in a trading strategy. Okay, so change something. Maybe you need to start trading in a different session. Okay, maybe a London session doesn't really work out for your mentality or trading style, so you need to start thinking about trading in the Asian session instead. Of course, it can be a bit difficult because we all work on different times. We have different time zones. Maybe you're sleeping during the Asian session, but still something to consider, right? Okay, Nenad is asking, you mentioned that it's good to let your account or two burn down. Why? Okay, it's an excellent question, and I think you might have a bit misunderstood me. I didn't say it's necessarily good to burn down a couple of your accounts. It sounds like you're doing it on purpose, right? What I meant is that if by any circumstance you actually manage to empty one or two of your accounts, okay, then it's a good learning point. That means that you need to change something. Okay, now it's always better to learn from others' mistakes first and just not repeat the same mistakes. But I also appreciate making mistakes myself and actually learning from my own mistakes as well, because these mistakes that I make myself, I'll be able to process better and I will be able to analyze better and remember better, just to know exactly what I did and what not to do in the future. Now, burning down a few accounts, saying again, it indicates that you need to change something, okay? And it's a good learning curve. So there's nothing wrong with burning down a few accounts, because believe me or not, most, if not all, professional and successful traders have been there, okay? The thing that made them different from the ones who completely fail is that they kept on going. They analyzed what they did wrong. They improved their strategy. They improved their approach towards trading, and they tried again. They went for another go. They improved themselves in overall, and that's what made them successful longer term. Okay, 95% of retail traders, they empty one account or maybe even two, and they give up because they are unable to analyze themselves what they did wrong. They let their emotions take control, and they simply give up. They say, screw trading, it's not for me. I lost money already, I don't want to have anything to do with this again, and they walk away. This is why 95% of people, or traders, actually fail. Okay, only 5% of people are the ones who are able to analyze themselves, what they did wrong, improve, and continue. It requires a very strong mentality. Don is asking, can you simulate a trailing stop loss, essentially, moving the stop loss further to protect the profits gained? I understand what you mean about this simulation of the trailing stop. I would personally in general, refrain from modifying or playing around with the take profit or stop loss levels. Although if that is something you personally feel that it makes you feel better, that you are, so to say, protecting some of the profits that you have earned, sure, you can go ahead and do that, but I wouldn't really recommend that, because it still creates this habit of playing around with the take profit and stop loss levels, and it's not really advisable, because later on you might expand the boundaries of modifying the stop loss take profit levels, and at some point it might actually pay back. And what I mean by that is, having a controversial effect. You might actually end up losing more than you expected. Okay, Corinne is asking, in respect of lot sizes, are very low lot sizes profitable for scalping? Sure, it depends on what account you are using. If you're using an ECN account that applies a certain amount of commission per trade, then obviously using too little lot sizes is completely silly, to put it really bluntly, right? Because the commission is already eroding away a large part of your potential profits. If you're using a standard account, then using a really low lot sizes, obviously you're risking a lot less, but you're also restricting yourself from actually making any um recognizable profits for you to actually feel that you are actually making it some money or some returns, because you're not really earning anything. You're simply just playing around, right? So having too little lot sizes is also relatively will have a negative effect. Okay, Kenneth is asking, is there a specific session that is favorable for scalping, like the London session, the US session, or Asian? Um, I wouldn't say completely favorable, although when coming back to our simplistic approach examples for ranging and a trending market, then you can apply um, the knowledge of what session you're trading in adequately. Because if you are trading late US session, you will most likely encounter more ranging markets that you would encounter during the London session, and especially London US session overlap. During those markets, you will either see heavily trending markets, or slightly trending markets, and really indecisive markets. But this is decisiveness, sorry, is really broad. Okay, so the prices can jump all around the place, and then not really, no really range is defined in those movements. So just yeah, this is the thought that you can apply when thinking about sessions. Jeremiah is asking a very interesting and at the same time a bit sad question, then: are there actually successful traders? Jeremiah, with um, peace of mind, I can say that yes, there are, although the percentage is very low. And that is the unfortunate takeaway from this, that 90% or even more percent of the retail traders actually fail at trading and end up losing money. Okay, only a very fraction of traders are able to consistently earn profits from trading longer term, and most of these 5% are doing or conducting trading on the side of their main job. Even lower percentage of these traders are actually trading as their main job. Okay, so trading and earning money by trading as their main job is even more stressful and requires even more um, sophisticated control over your emotions. A really strong person. Okay. Patricia is asking, what lot size do you suggest for a $500 account? I do apologize. I am not an investment advisor. I am not able to provide you with a lot size that you should apply to a $500 account. Although I can say that $500, to my personal opinion, is complete minimum that you should start with. An adequate, not completely adequate, but leaning towards adequate amount would be $1,000 to start off with. And if I had a $1,000 account, then of course, depending on how much experience I have had on trading the markets, but based on my current experience, I would use lot sizes of anywhere from perhaps 0.1 to 0.5 on a 1,000 account. Okay, so on a $500 account, I'd definitely keep at 0.1 if you're using a standard account. So not larger until you actually have earned some profits. Then just decide to increase it a bit. But it's really good to keep in mind to trade only 1% of your total account equity per trade. Okay, I'm being notified that we are way past the 1 hour mark of the webinar. I got a bit carried away and forgot to check the clock. So if any of your questions does remain unanswered, sorry for that. There are a lot of them coming in. So please send your questions to webinars@hotforex.com. And they will be more than happy to answer. And thanks a lot for attending this webinar. It was my pleasure to host it today. And we'll see you next week with a new topic. Take care, everyone, and trade safe.